I present before you the monetary policy statement of today. And this is how it goes. As we stand at the threshold of 2025, let me reflect upon the eventful journey of 2024. In line with the trend in the last few years, central banks were once again put to the ultimate test to stabilize their economies against continuous, colossal, and complex shocks. Central banks are constantly adapting to the new global economic and financial landscape created by geopolitical conflicts, geoeconomic fragmentation, financial market volatility, and continuing uncertainties, all of which are testing the resilience of the global economy. The last mile of disinflation is turning out to be prolonged and arduous, both for the advanced economies as well as the emerging market economies, that is the EMEs. Maintaining macroeconomic and financial stability and building buffers continue to be the lodestar, especially for the emerging market economies. In India, notwithstanding the recent aberration in growth and inflation trajectories, the economy continues its journey on a sustained and balanced path towards progress. Amidst the reshaping of the global economy, India is well positioned to benefit from the emerging trends as it forges ahead on a transformative journey. Let me now turn to the decisions and deliberations of the Monetary Policy Committee, which met on 4th, 5th, and today 6th December. After detailed assessment of the evolving macroeconomic and financial developments and the outlook, because monetary policy is forward-looking, so we have to always look at the outlook, the Monetary Policy Committee decided by a majority of 4:2 to keep the policy repo rate unchanged at 6.5%. Consequently, the standing deposit facility, that is SDF rate, remains at 6.25%, and the marginal standing facility, that is the MSF rate, and the bank rate at 6.75%. The MPC also decided unanimously to continue with the neutral stance and to remain unambiguously focused on a durable alignment of inflation with the target, while supporting growth. I shall now briefly set out the rationale for these decisions. The MPC took note of the recent slowdown in the growth momentum, which translates into a downward revision in the growth forecast for the current year. Going forward into the second half of this year and the next year, the MPC assessed the growth outlook to be resilient, but warranting close monitoring. Inflation, on the other hand, surged above the upper tolerance band of 6% in October, driven by a sharp uptick in food inflation. Food inflation pressures are likely to linger in Q3 of the current financial year and start easing only from the Q4 of the current financial year, that is from January to March. And we expect that this is the trend, and it will be backed by seasonal correction in vegetables prices, Kharif harvest arrivals, likely good Rabi output, and adequate cereal buffer stocks. High inflation reduces the disposable income in the hands of consumers and dents private consumption, which negatively impacts the real GDP growth. The increasing incidence of adverse weather events, heightened geopolitical uncertainties, and financial market volatility pose upside risks to inflation. The MPC believes that only with durable price stability can strong foundations be secured for high growth. The MPC remains committed to restoring the inflation growth balance. I repeat, the MPC remains committed to restoring the inflation growth balance in the overall interest of the economy. Accordingly, The MPC decided to keep the policy repo rate unchanged at 6.5% in this meeting, and also to continue with the neutral stance of monetary policy, as it provides flexibility to monitor and assess the outlook on inflation and growth, and then go on to act appropriately. I would now like to provide an assessment of growth and inflation, and I would like to begin with the global growth scenario. The global economy has shown unusual resilience in 2024, despite several headwinds. Inflation is gradually moving towards the target from its multi-decadal highs, prompting several central banks to embark on policy pivots. Global trade remains resilient, with increasing volumes confined within geographical blocks. Since the last MPC meeting, financial markets have remained edgy amidst rising US dollar and hardening bond yields, resulting in large capital outflows from emerging markets and also in volatility in equity markets.